financial advice, pensions, investment planning boring, aren't they? Well, we'll hopefully just try and sort of smash that myth a little bit. My name's Simon Baldwin. I run High House Wealth Management. We're a practice of financial advisors based in Bromsgrove underneath the umbrella of St James's Place Wealth Management. And generally speaking, pensions, investments, generally are boring, aren't they? But they are important. So my message today is really the importance of having financial advice and how having a good financial advisor and engaging with them could be worth up to 3% extra investment growth every year. And also why having a financial advisor would help you avoid the common pitfalls that often beset the do-it-yourself investor. So common misconceptions, and I don't think this is specific to financial advice. I think it can cover a multitude of different businesses where people think they can look after things themselves. I don't need advice. It's expensive. What's the value in all of this? And do I make any money after I pay the fee for a financial advisor? And these are just some of the common reasons that people may shun financial advice. Other reasons could be historic. So the industry, or the profession, as I like to call it these days, I think we're a lot more professional than when I first joined it 20 odd years ago, had a bad reputation. There were scandals of pensions mis-selling and endowments mis-selling in the 80s and the 90s. And again, it's an emotive subject. People work hard to earn their money and fiercely guard it, quite rightly. So their feelings are amplified when it comes to dealing with their money, especially when it's large sums, or when they've worked hard all their lives and have got pension pots that they want to give them a comfortable and happy lifestyle once they decide to finish working. And there is a stereotype out there of the commission-hungry financial advisor that wants you to be signed up to their latest scheme as quick as possible and kind of rush you out of the door before you've even had a chance to sort of ask a question or think about what's the implications. Essentially, that's not how our profession works these days. In fact, there's a report that was commissioned in 2017 called The Value of Financial Advice, and 9 out of 10 people are satisfied with the advice that they give or receive, that the advisors give to their clients. That's the International Longevity Centre that tells us that. So, the vast majority of people are happy with the advice that they get and are really pleased and are getting good results. Otherwise, they wouldn't be engaging with a financial advisor. But some people are put off. So a third of people surveyed said they're put off by the cost alone of the advice. But these people don't really understand the cost of not taking advice, which is probably a better way of looking at it. And, what advice can add is quite surprising, and people often don't recognise that. And I'll move on to tell you a little about that in a second. So we call it advice alpha. What is the value that the financial advisor adds to you? So these are just a number of things that help that advisor-client relationship. A portfolio rebalance sounds not the sort of thing that trips off the tongue, but it's making sure that the investments are the right investments and making sure that they're tweaked and changed on a regular basis to reflect the client's needs and their attitude to risk. It's about designing a financial plan. So what are the client's aims, aspirations, and how do the products and services that we offer fit into that plan? There's also coaching and mentoring. So educating the clients about things like the tax allowances that they can use and making sure that they do use them. And because some of these allowances are use it or lose it allowances. For example, an ISA, you can put £20,000 in every single tax year currently. But if you haven't done it in the last tax year, you can't play catch up. And one of the other important elements is cash flow planning, because people want to know how long their money's going to last once they finish work. So we can map that out for them, including their income from whatever sources they are from, but also any capital expenditure. So, a big holiday or a purchase of a new car. I've got one client that purchases a new car cash every 5 years, and that's got to be built into the plan. And the tax allowances are really, really important. And I worked with a client recently who is a higher rate taxpayer and has been contributing to a pension. Prior to starting the pension, they were a basic rate taxpayer. So with that, it's quite simple. The pension company will claim the tax relief for you, make sure that that's added to your pension. And it's an extra 20% that goes into the pension, which is very valuable. However, a higher rate taxpayer pays another 20% tax. So the total tax on some of their earnings is 40%. Now, to get that extra 20% value from the taxman, you don't have it claimed by your pension company. You have to actually speak to the taxman yourself. And the gentleman I was working with earlier in the year wasn't aware of this. So I pointed him in the right direction to speak to HMRC over the telephone. And the result for him, within a short space of time, 2 or 3 weeks, he was credited or given back from the taxman £7,500. So it just shows you, had he not sat down with me, he would have been oblivious to this additional tax relief that he was entitled to. And what we actually do when we're sitting in front of the clients, their experience is probably just the tip of the iceberg. There's more to it than a half-year review or an annual review. There's a lot going on behind the scenes that the client doesn't actually see, may not even realise that we're doing it. We've got the below the waters, if you like, is making sure that we're keeping the advice on track behind the scenes. We're answering their emails, we're taking their phone calls, all within a timely fashion to be able to return their calls or give them the answers. We're giving them active guidance in all areas of financial planning. So I may have a client that's just got perhaps a pension that we look after for them. However, there'll be other areas that they may need advice on. They may need to be pointed in the right direction for a mortgage. They may want to pick my brains on some tax related to other products that they may be considering. We also look at their risk profile. Is that shifting? Is it changing? Do the investments they have still match that risk profile? So this is all going on in the background. We keep them up to date with the legislation changes through our email update service. So if there's been a budget, has the ISA allowance changed? What changes have there been to pensions? Are there any more reliefs that the client can claim? So all of this stuff is built into what we do in the background that the client doesn't necessarily see, but they actually do get some value from it because we're in the background working. We'll also consult with their other professionals. So a will writer, for example, who needs to know what assets they've got, and the client knows that we've got a list of everything they own. So rather than passing that information on off the top of their head to the will writer, we can give them a specific list of everything they've got. Or when it comes to working with their accountant, there's the retirement pension contributions that they've made, and the accountant might need to know that for the purposes of a self-assessment. So we have that sort of joined up approach with our clients' other professional advisors where necessary. The other thing I mentioned earlier was kind of DIY investing. So, people will do it themselves. I have clients that have a smaller portfolio that may do it themselves, but very often it isn't quite as well put together as what we would do for them, because they tend to put their money in too many shares of the one type or one company or one region of the world. They may only just buy shares, where we put together a broad spread of investments within a portfolio that doesn't include only shares. There are other assets as well to give them a good spread. The better the spread, the less ups and downs the client will experience during that journey. And they're very hands-on often. They'll mess about, they'll read something, see something on the news, and they will often make a knee-jerk reaction on the back of something they've seen or read. And one of those things is, bailing out and panic selling when there is a market downturn like there was after we first entered the lockdown. Generally speaking, a DIY investor will buy when the market is good. So when prices are high. They'll sell when prices are bad, which is counterintuitive. And the research suggests that after the last crash, the big crash in 2008, that the people that did it themselves sold out the market as fast as they possibly could when it started to drop. And to get that money back into the market, it took them up to 5 years to be fully invested from the position they were before. So from that point of view, it's really good to engage with a financial advisor, because what we do, we hold their hand, we pick the phone up, we tell them, yes, it is bad, but let's look at the plan. The plan is not to sell in 2020 because there's a crash. The plan is to keep this money invested for your retirement, which could be 5, 10, 15 years ahead. And the other thing is important to realise is that we're all living longer. The 100-year life is something that's going to be 1 in 4 people that are born this century have got a very, very good chance of living to be 100. And this is a quote from a gentleman that was the oldest man in the world at the time when asked about why he was so old and what was his secret to a long life. His name was Alexander Imich. He died, unfortunately, in 2014, but his quote was, "I don't know, I simply didn't die earlier." He's got no idea how it happened. So there's no secret. It could just happen to any of us. And, living too long and running out of money is a big concern because people don't know how long that pot of cash is going to last. So if we refer back to the cash flow planning, that is a great thing to do because we know how long that money is going to last. And if we do it early enough, pre-retirement, people know how much money they need to save for all those things they want to do when they're retired. And it's just simply working with them to make sure there's a plan in place so they never, ever run out of money. A lot of people I come across have got a bias, if you like, to property, buy-to-let investing. And there's nothing wrong with that. It's just that I think most people, because they own a property, they've seen the value increase over time, and then they think it's a great alternative to putting money into a pension or an ISA for that sort of thing. And I basically say to people, look, you've got 2 choices here. You can invest in an asset that will be taxed as you buy it, taxed on any profits all the way through and taxed when you sell it or when you die, or you can take advantage of an asset where the government will pay into it for you. They won't deduct any tax from you as you grow your money. And at the end, they'll give you some of that money back tax-free. And what I'm talking about there is a pension in the second option. The first option is investing in a UK buy-to-let property. And there's a question, which would you choose based on those 2 analogies? Because the graph here shows the difference between investing in pensions over the last 20 years compared to UK property. And because of that tax efficiency that the pension offers, it outweighs in terms of growth what the buy-to-let property might do for you. So it's just pointing out some pitfalls that people may fall into because of this desire to do everything themselves. So from that point of view, I don't suggest that property is a bad investment. I just wouldn't advocate the people that I speak to building a property portfolio like a lot of people have the ambition to do. It's good to have a spread because if the property market goes, then that could be your future lifestyle going. So by putting it in pensions, ISAs, and some property, then you get a good spread. If one's doing badly, another may be doing better to compensate for it. So in summary, I'd say always take financial advice. It adds value. A survey by a company called Vanguard have identified it 3% can be the extra annual growth that you receive by having an advisor. It can take the emotion out of doing it yourself and avoid irrational decisions about what to do when markets change or drop. And make sure you don't run out of money before you die through cash flow planning and careful investments for the client that suits them. Because the right choice of investment is key to everything that we do for our clients. So that was it. I'd just like to finish by saying that I mentioned earlier, I work under the umbrella of St James's Place, and one of the unique things about St James's Place is the advice guarantee. So we hold ourselves to high standards, we're confident about the advice that we give, and in practice we make sure that we give the right advice